Hey, it's Tom here and welcome back to the channel. So as many of you will know already, Alibaba has been an extremely hot topic in the investing world. At a high level, Alibaba is getting a lot of negative press and the stock is down peak to trough very close to 50% now as of recording this video. So it's wiped out a lot of market value for not only Alibaba but many different Chinese stocks. But when you then contrast that with sort of the value investing community here on YouTube and more broadly as well, you really actually get a lot of positive takes on Alibaba, and you're seeing a growing list of super investors add Alibaba to their portfolio. So there is a lot to talk about with Alibaba, and I want to talk through several of those things on the channel. So I think this is probably going to take more than one video to get through everything. So consider this part one and maybe a 2 or potentially 3 video long series on the channel. But lots of stuff to talk through. I want to start out with some of the bigger, more controversial things around Alibaba with a potential delisting risk. I also want to talk through the VIE/ADR kind of Cayman Island structure with Alibaba and actually many other Chinese companies for that matter. I also want to talk through some of the recent fines Alibaba have had, as well as not technically a fine, but kind of like a pledge that Tencent has recently made. I also want to talk through the chaos that happened with a lot of education stocks in China a few weeks back. I want to talk through share buybacks, and I also want to share my thoughts on the actual intrinsic value for Alibaba as well. So for this first video, the main focus will be firstly the delisting and also the VIE/ADR structure, and whether you're potentially better off buying the Hong Kong listed shares of Alibaba versus the US listed one. I know that is a hot topic as well. So if you enjoy the video, please hit like on it and also consider subscribing. I put up a community post here on YouTube the other day saying that at 30,000 subscribers, I'm considering giving away one of these bad boys, Poor Charlie's Almanac, and I think I am going to do that. So please subscribe to the channel if you haven't already. Once we hit 30,000, I will release some details on giving away a copy of good old Poor Charlie's Almanac. But for now, let's get straight into the video. Okay, so one of the main talking points recently with Alibaba is the potential for the stock to get delisted. And I want to talk through why that may or may not happen, and also some of the things that actually drive that decision for Alibaba to be delisted. So currently Alibaba is listed on the New York Stock Exchange under the ticker BABA. It's also listed on the Hong Kong Stock Exchange, and it's also actually listed in Frankfurt, I believe, as well. So there's 3 different versions of Alibaba that you could technically go out and buy. But when it comes to delisting, we're really just talking about the US version. And this concern has really been raised since a law was passed in December 2020, 18th of December 2020, and the law is called the Holding Foreign Companies Accountable Act. So this kind of came to fruition really for a couple of different reasons. So the law was sort of introduced as the whole US-China trade war stuff was going on. That's when this law kind of first got into the works over in the US, is when all of that was sort of going on. And it actually sort of coincided with some drama that happened with one of the Chinese listed US companies as well. So you may remember a fraud case with a business called Luckin Coffee. Now, Luckin Coffee were actually found to be faking about $310 million in sales right at the time this bill was kind of in the process of getting passed. The CEO and the COO ended up being fired, and peak to trough, the stock was down about 97%. So that's one of the really good reasons why this kind of law was introduced. It's a way to make sure that US investors are getting good information about the companies that they're actually putting their hard-earned money into. And there's a few requirements that have kind of come in for these Chinese businesses as a result of this law passing. When it comes to these Chinese businesses, and of course Alibaba is included in the mix, there's basically 2 things that they need to tick off in order to kind of remain listed on the New York Stock Exchange in the case of BABA. So the first thing they have to prove is that they're not government controlled or owned. So I'll talk through kind of what that means specifically for Alibaba shortly, but that's kind of the first thing on the list. And the other thing that they have to do is make sure that their auditor is certified, and they're certified by a party called the Public Accounting Oversight Board. And throughout this video, I'm going to try and sort of refrain as much as possible from giving you my personal opinion. I know there's a lot of personal opinions kind of on both sides of this discussion for Alibaba and for Chinese stocks generally, but I'm going to do my best to try and refrain offering my opinion per se on some of these matters and just frankly get straight to a lot of the facts so that you can kind of make up your own mind on what you think might happen with these businesses. So like I say, there's sort of two things that Alibaba has to tick off in order to not get delisted from the New York Stock Exchange. Firstly, they have to prove they're not owned or controlled by a foreign government, of course, in this case being the Chinese Communist Party, and they also have to have an approved auditor. So this is kind of where things sit for each of those two aspects that Alibaba has to pass at the moment, and I should say that they have 3 years to kind of figure this out. So it's not like a delisting is just going to randomly happen tomorrow. They've got a few years to sort of work through this process. So in terms of being government owned and controlled, this is an interesting one to kind of think through. So Alibaba has kind of been in the doghouse of the CCP for some time now. So you may remember that Alibaba actually received quite a large fine, about $2.8 billion US for anti-competitive behavior. I'd argue that's not typically something that you would see a government department receiving. And the other things to keep in mind is that Alibaba itself isn't actually necessarily listed on the New York Stock Exchange. So what you're actually buying when you buy Baba on the New York Stock Exchange is you're buying into something called Alibaba Group Holdings Corp, which is actually an entity based in the Cayman Islands, which was set up for the entire reason of, allowing foreign ownership, essentially. So that's where things sit in terms of being government controlled and owned. I think most people hopefully would agree, and I'm going to, again, try to refrain from giving too much of my personal opinion on this, but I think most people would generally agree that if you're a business that's getting fined by the government and you're also listing in the Cayman Islands and setting up this variable interest entity structure in order to allow foreign ownership, you're probably not a government owned and controlled body. So I'll just leave it at that. The other thing on the auditing side, so in terms of getting approved auditors, this one is fairly straightforward for Alibaba. So Maggie Wu, who is the CFO of Alibaba, Chief Financial Officer, said this on a Baba conference call back in 2020. So they said, "We are closely monitoring the developments of this bill. Alibaba's financial statements are prepared in accordance with US generally accepted accounting principles. The integrity of Alibaba's financial statements speak for themselves, and it's also worth noting that Alibaba has had its accounting and auditing done now for over 20 years by one of the big name accounting firms being PwC. So that's where things sort of sit in terms of what Alibaba has to do to make sure they don't get delisted. But if hypothetically they were to get delisted, let's have a quick look at what may actually happen. So I think Luckin Coffee, like I mentioned earlier, that had the fraudulent accounting and so on, is a pretty good case study here. So they actually did get delisted from the NASDAQ in that instance. You can still buy shares in Luckin Coffee. So although they don't trade on the NASDAQ anymore, they do still trade over the counter. Now, that doesn't necessarily mean that if Alibaba gets delisted as well and then trades over the counter that it's entirely smooth sailing. I almost guarantee there is a lot of institutional selling and so on that would happen if that were the case. There's certain institutions that are going to have rules in place that they can't own over-the-counter securities and that sort of stuff. So it'd be pretty hard to argue that getting delisted from the New York Stock Exchange and trading over the counter would be a positive thing for Alibaba. But the shares aren't just going to evaporate into thin air. They are going to probably continue to trade over the counter. And of course, if you want to kind of eliminate this delisting risk in the US, you do have two other options in terms of owning Alibaba stock. So you can either go and buy it on the Hong Kong Stock Exchange, or you can buy it on the Frankfurt Stock Exchange. Okay, so next up, let's talk about the VIE and ADR kind of structures that are in place with Alibaba. And like I say, you can kind of lump many of the Chinese businesses listed in the US into these categories. Let's talk through what's going on there. So a VIE stands for Variable Interest Entity, and an ADR stands for American Depository Receipt. Now, ADRs have been around for a long time, and that really I don't think is the issue here for some of these Chinese businesses. It's more of kind of the VIE side of things, but I'll talk through each, and let's start with the ADR because that's kind of an easy-ish one to sort of get out of the way. So ADRs have been around since 1927 is actually when the first ADR I have learnt actually happened. And that was actually when JP Morgan launched the first ADR program to allow American investors to buy into a UK business. And that UK business, just in case you're wondering, was called Selfridges Provincial Stores Limited. I have no idea what they do, but that was kind of the first ADR that was introduced into the US back in 1927. Now, this is basically, like I say, set up as a way for US investors to buy into foreign stocks, and it has a couple of advantages. So instead of going to a stock exchange in some other country, you can buy these ADRs simply on a US exchange. You can buy them on your local exchange, they are listed in US dollars, and you get your dividends paid in US dollars as well. Now, a common misconception and one thing that ADRs don't eliminate is foreign exchange risk. So you may think that if you're a US investor and you're buying a US denominated kind of ADR, that you eliminate any foreign currency risk and so on. That's not really the case. If you buy into Alibaba, they still earn the majority of their revenue in Chinese yuan or RMB. So as exchange rates fluctuate, you're going to see that flow through to the quoted US dollar price of your ADRs as well. Now, another thing worth noting is that typically an ADR will have a sponsor, and that will be some sort of investment bank. So in the case of Alibaba, that is actually Citibank, and Citibank basically takes a very, very small fee for operating this service and running this sort of ADR program. So in the case of Alibaba, you can look this information up and you'll see that Citibank basically receives 2 US cents per ADR every single year. So if you look at that 2 cent essentially fee on a $160, call it share price as of recording this video, that is a 0.0125% fee, more or less. So it's a very, very small fee, but it might be something worth considering that Citibank is getting some revenue from kind of running this service for US investors. Okay, so the next thing to talk about, and the final topic I kind of want to cover in this video, is the actual VIE structure. Now, this is really where a lot of the controversy comes in. So a VIE, like I say, is a variable interest entity, and I will put up a diagram here of what that actually looks like at Alibaba. So the reason a VIE was actually set up in the first place is because foreign investors are technically not allowed to own certain key Chinese assets. So instead of buying into Alibaba directly in China, this sort of variable interest entity was set up in the Cayman Islands that, as you'll see on this diagram, has a series of contracts in place which allows this variable interest entity in the Cayman Islands to have contracts which entitle them to the profits of the real operating businesses of Alibaba. And the first VIE for a Chinese company was set up over 20 years ago now. So it was first done by a business called Sina.com when they went public on the NASDAQ in 2000. And since then, there really haven't been many issues with it. The Chinese government hasn't come in and kind of torn these things to pieces or anything. It's been running for about 20 years or so, and it's been a controversy basically since then. But by and large, there has been no action to kind of try and remove these VIE structures. But it is certainly an added layer of uncertainty for investors, and it's something that is worth considering. I guess a few things that you would also have to note with these sort of VIEs and ADRs and all that sort of stuff versus just buying straight up shares in a US business is that there are also some different regulatory filings you'll see. So with most US businesses, you'll see a quarterly filing called a 10Q. You'll also see an annual filing called a 10K. Those have slightly different formats and names for some of these VIE structures. The annual reports you'll see called a 20F, and the quarterly reports you'll see called a 6K. So that is basically what the VIE structure is. Rather than owning Alibaba directly, you own this entity in the Cayman Islands, in this case called Alibaba Group Holdings Limited, which has these contracts for the profits of Alibaba's operating businesses. And again, many people will say, why don't you just go and buy the Hong Kong Stock Exchange listed version of Alibaba and kind of just forget this whole thing? One thing to keep in mind, which is quite important actually, is that if you go and buy the Hong Kong listed version of Alibaba, you are actually still buying into the VIE. So you are still buying into Alibaba Group Holdings Limited, which is the VIE in the Cayman Islands. And although you're kind of negating that risk of delisting from a New York Stock Exchange like you might in the US, you're not going to be able to get out of this kind of VIE structure. And even though you may have escaped the delisting risk, if delisting does still happen in the US, the Hong Kong listed version of Alibaba and the US listed version of Alibaba trade for basically the same valuation. So if you have a bunch of selling in the US, I don't think you're going to be immune from all that selling pressure in Hong Kong either. But if that's something that gives you a little bit more peace of mind, that may be an option for you. So that's it for this video. I do hope that was informative for you in terms of the delisting risk and what Alibaba actually has to comply with in order to not get delisted and the timeframes they've got in place. And I hope that helps you to a little bit better understand the whole ADR and VIE structures in place as well. Now in the next video in sort of this series, I want to talk about some of the fines that Alibaba have had for their anti-competitive practices, and also a recent pledge that Tencent has made. We'll talk about education stocks, buybacks, and also my intrinsic value calculation for Alibaba. So that's it for me for this one. I do hope you enjoyed the video. If you did, please hit like, and like I say, giving away a copy of Poor Charlie's Almanac at 30,000 subscribers. So if you haven't subscribed already, please do. I would love to have you join in along on the channel. But that's it for me for this one, and I will see you in the next video. Cheers.